delve deep into, explain a little bit more about why it's important. I also want to talk about the Federal Reserve's BTFP program, the Bank Term Funding Program, and really dive deep into that as well, and kind of show how that's been a very pivotal factor influencing the market along with CPI. Now, I know I haven't really uploaded many videos recently. I do have a full-time job. It's pretty demanding. It is summertime, but I'm hoping to get more videos out there, especially, as the seasons change and summer comes to an end. But anyway, let's dive right into it. So this is basically a graph of CPI over the years, month by month. And you can see here that, anybody who's been following the market knows that CPI started to creep up in 2021, really dramatically right around that April timeframe in 2021. And it continued going up month after month, peaking in June of 2022. That was the absolute peak. And it's been declining ever since, down to basically where we are right now. So this video is pretty timely in the sense that we actually had the CPI data release yesterday for July's CPI data coming in at 3.2. And I've seen a lot of different takes on this on Twitter, but some people saying that this is the only increase since the peak in June of 2022. You've had consecutive declines in CPI every month for 12 months until July. And then you had another uptick to 3.2. But I think, people are sort of losing the forest for the trees, right? I mean, they're missing the big picture, which is that CPI has declined dramatically from a year ago. Okay, it ticked up, but, you got to see the forest for the trees. Now, if you see, a consecutive, say, August came in, at 3.9, and then September comes in at, 5.1, and you see this sort of consecutive CPI increases at an accelerating rate, then maybe, you'd have argument there that, okay, CPI has bottomed out and it's starting to accelerate to new highs. But we're not there yet. We need to see that. If we go over to the SPY chart, this is the S&P 500. I've sort of marked off, sort of around the time frame when CPI is released. It's usually released on a monthly interval, although it's not a perfect monthly interval. It's usually the second Thursday in any month, roughly. So we just had ours yesterday, second being the second Thursday in August, and we'll have one a month from now. And these consecutive declines in CPI have really been a driving force for the stock market to go up, right? The CPI peaked in June, the market bottomed in October. It didn't really get started ripping until March. And we'll talk about that significance. That sort of ties into the Bank Term Funding Program. And we'll get to that in a second. But, here we basically have declining CPI. And again, I think if you, hypothetically, if you had, next month come in at 4.1, and then the month after that, say you had October's CPI come in at 5.1, you have that acceleration in CPI, then I think, you could expect the market to sort of top out in that region. And that would sort of coincide with, let me mark the quarterly close on here. Okay. So the end of the third quarter will close right here. And I think this third quarter is really important. Because for the bullish case, if CPI is going to continue declining and the equity markets are going to make new highs, I think, we would want to see that sooner than later. And I think there is a good case, if you have, say hypothetically September CPI comes in, say below 3% at 2.8%, that you could see the third quarter SPY or S&P 500 close above the all-time highs, and that would really be the rocket fuel for what I've been talking about recently, which is a parabolic blow off top. If you get that quarterly close above the all-time highs. Again, this is all contingent on CPI performing a certain way, and we don't really know what CPI will do ultimately. All we can really react to is that, we just can react to the numbers that are released. The CPI figure is not an objective measurement of anything. It's a manipulated government figure that doesn't really represent anything, and yet it still has a lot of significance on the markets, which is sort of a subtle nuance that a lot of people have a hard time grasping, but it is very important, right? CPI does not reveal anything objective about our world or our reality, but markets still react to it, right? And the reason why is because CPI is the basis for a lot of the behavior that the Federal Reserve is doing, or Federal Reserve policy. So, based on what we've seen in the market, and I should have pulled this tab up, but based on the recent CPI print, the market has priced in that the Federal Reserve will not raise interest rates at their next FOMC meeting in September. So, the market is generally right with those predictions. I can't remember the last time it's actually gotten an interest rate prediction wrong. So, I think we'll probably see, and that's sometime in mid-September, sort of around the next CPI print. So, I think the market would interpret a pause extremely bullishly. Because markets are forward-looking and they look over the curve, and for them, a pause is it signifies that the Fed is done raising interest rates, and because markets are forward-looking, that'll cause a lot of capital to shift, and cover short positions and get more bullishly positioned. But again, that is conditional on certain circumstances coming to pass, which may or may not come to pass. We just have to sort of wait and see that out. But as for now, my base case is sort of that we continue to see CPI not necessarily make new lows, but stay relatively low and stay, extremely low relative to the prior peak. So it'll be interesting to see how that plays out. Now, one thing I want to take your attention to is this tweet here from Joe Consorti. If you guys don't follow Joe Consorti, I highly recommend you give him a follow. He posts some valuable things. But here he's talking about the Fed's BTFP facility, which is the Fed's Bank Term Funding Program, has risen to a new all-time high of $106 billion in outstanding emergency loans. So the Federal Reserve is providing liquidity to banks that need liquidity, also known as a bailout, which tends to be very bullish on asset prices, right? If you have bank bailouts, that's, it just sort of pumps equity prices. And we can see that here. So, after the Silicon Valley Bank collapse, which actually occurred right here in March, let's see. It was actually during this weekend, in early to mid-March, around that 12th, 13th, you had the Silicon Valley Bank collapse, and the Federal Reserve unveiled the BTFP program, the Bank Term Funding Program, that weekend. And you can see that ever since the Bank Term Funding Program was revealed, that was the low before the market just started ripping up. Now, the market had already bottomed in October, right here, but it's sort of languishing around sort of this area. It didn't really start ripping until the Fed unveiled that new bailout facility right here. And what's significant is that the you had a initial surge of 60 billion, but you're still seeing rising loan issuance in this facility up to now all-time high, which is telling you that the Fed this is just another form of QE. People say it's not QE because it's taking a different format. Typically, the QE people are familiar with is when the Federal Reserve buys, treasury bonds and puts it on its own balance sheet. But, what you have here is you have, banks being encouraged to buy bonds and put them on their balance sheet because the Fed is guaranteeing those bonds. And if there's any liquidity issue, they've basically promised to provide unlimited liquidity to cover any losses, to theoretically cover an unlimited amount of losses. There's no cap on the amount of liquidity they'll be provided. But the Fed is lending to these banks at the 1 year fixed swap rate. So this is the website I use for work. It's Chatham Financial. You can, anybody can Google it. But it does provide pretty accurate 1 year swap rate data. And you can see here, this is the U.S. Treasuries, but the swap rate is also referred to as the SOFR swap rate. It's right here. You get your 1 year current is 5.22. So what that tells you is that, banks essentially, there's a lot of layers to this, but basically what you're seeing is that the Fed is providing unlimited liquidity at the 1 year fixed swap rate at 5.22. So that essentially sets both a yield floor and a yield cap on bonds. So, one thing you can see here is that, bonds are not, we're looking at the U.S. 2 year bond, and it's sort of topped out around 5%. And there's a reason for that because, in my opinion, because of the Bank Term Funding Program, because let's say that the 2 year bond was yielding 5.6%, theoretically, up in this region. Well, then there's an incentive for banks to buy as many 2 year bonds as they can possibly as they can possibly buy because of the Bank Term Funding Program, because they can have their losses guaranteed on that bond at 5.2%. So even in the worst case scenario, the worst possible scenario that could ever play out, where they need to sell all of those bonds at a loss, or I should say pledge those bonds as collateral to the Fed, at a loss and receive that liquidity, they're still capturing the positive differential between the 1 year fixed swap rate and that 2 year bond at 5.6%. They're still capturing 40 basis points in the worst possible scenario that you can create. So you can see how it's like sort of creating it's in my opinion, it's a yield curve control. And, you can see that yields are sort of topping out at that region, at that 5.2%. So, who knows if it's just a theory, but, it's something to keep an eye on going forward. Do yields rise above the 1 year fixed swap rate? Personally, I don't think they will, but certainly it's not a guarantee. Just something to keep an eye on. Now, one effect that has had on the markets is, you may have heard of an inverted yield curve. That's where the in a bond market, you have like short duration maturities on bonds, which are 1 year, 2 year, 5 year, 10 year. Well, 10 years not really short, but you even have T-bills like 1 month, 3 month, 6 month, 1 year, 2 year. Those could be considered the short end of the bond curve. And then you have the long end, which is 10 year, 20 year, 30 year. And basically what an inverted yield curve is when you have a distortion, when you have the short end of the curve yielding more than the long end of the curve, which like sort of like is a sign that things are really bad, because it doesn't make sense. Like, why would you lend for a longer term? Why would you lend your money to someone for a greater amount of time for less return? It shows that there's like a real distortion in the time and price of money, and that's why like inverted yield curves generally tend to lead to a recession, because it's a sign that there's a lot of distortion in the market, and that the market and bond markets, broadly speaking, are very unhealthy. And I think, prior to CPI sort of topping out last year, I think that's sort of around when we saw like the peak in the inverted yield curve, or that being the divergence between the short end of the curve and the long end of the curve. And it's still inverted, right? You still have the 2-year right here yielding 4.8% and the 30-year yielding 4.2%. So the 2-year is still like 60 basis points above the 30-year. So it's still inverted. It's just inverted less. That gap used to be, a couple months ago, it used to be like 100 basis points, for example. But the reason why this is important is because the BTFP program is solely based off the 1-year fixed swap rate at 5.22, and that applies to the whole yield curve. So your short end, even your 1-month treasury bills, or your 30-year bond. So actually, that's interesting. Let me see if I can pull up the 1-year yield. Oh, excuse me, the 1-month yield. Here we go. If TradingView would pull it up for me. It always seems like technical issues come up at the exact worst possible time. Let's see if we hit refresh here. Try it again. 1-month yield. There we go. Okay, here we go. So here's a good example. You can kind of see how there's clearly a lot of resistance up here. Certainly above the 5.22 level, right? And it's sort of broken above there, but put yourself in a bank's shoes, right? Like they can, going back to the 1-year fixed swap rate, you can buy 1-month T-bills, and really there's not a lot of duration risk there. You only have to hold it for a month. If yields rise during that period, you don't have to hold very long to maturity to get paid back full. And it's yielding 5.38%. So even if you had to sell those bonds, right, or pledge them to the Fed for liquidity, you're still capturing the spread between the 5.388 and the 5.22 cost of capital. So if I were a bank, if I were a managing money for a very large institution, like your JP Morgan, somebody like that, I would be buying 1-year government bonds in serious size at this point, just because of that BTFP facility. That's sort of the incentive structure that has been established, and what it's doing here is, you can tell 30-year yields have been on a complete rise. Let's see if we can. Okay, so this is another great post by Joe Consorti. So the last 30-year U.S. Treasury bond auction, the Federal Reserve bought $8.6 billion in bonds, and that was basically 40% of the entire $23 billion issued at the auction. That's really, really high, and the Fed's buying a lot of long duration bonds. Even, when they claim to be doing quantitative tightening, right? And they say they're doing quantitative tightening, but they're buying 40% of an entire Treasury auction, right? That's quantitative easing. So I don't really see any way around it. But point being that, like, even despite the Federal Reserve buying a lot of long dated bonds, yields have still risen pretty dramatically on the 30-year. And the reason why is because of going back to that 1 year fixed swap rate of 5.22%. It's like sort of a magnet on bonds. It's, it's creating a cap on bonds and yet also creating a floor on bonds at the same time, sort of around that 5.22%. And so there's an incentive for yields to rise to that 1 year fixed swap rate, and for any yields above it to fall down to the 5.22%. So it's like a yield curve cap and a yield floor, magnet at the same time, or a yield magnet. But so even despite that, you've got the 30-year yield rising dramatically, despite the Fed buying 40% of the auction. And who this really hurts is like, not really banks so much. Banks aren't generally that far out on the edge of the curve. I mean, they are somewhat, but usually most banks issue loans for a term of like 5 to 10 years. So the banks tend to hold a lot of 5-year treasury bond maturities and 10-year treasury bond maturities, because any financial institution, they basically take their assets and their liabilities, their loans issued or the type of bonds they purchase, and they try to match them. So if you're issuing like 5-year loan terms or 10-year loan terms, that bank is probably going to buy 5-year treasuries or 10-year treasuries. Just sort of the way that the industry works. So when you get like further out on the yield curve, like towards like 30-year or, even beyond that, like some countries have 50-year, 60-year bonds. The type of institution that are buying those are typically pension funds and insurance companies. So, because their assets are so long dated, their liabilities are so long dated, right? The liability to pay out in the future can sometimes be beyond 30 years. They tend to be in the effort to match that, they tend to be the people buying 30-year treasury bonds, so they're, yields rising on them, they can get in a lot of trouble, and they do tend to be leveraged. So yeah, I would say insurance companies and pension funds have been having a bad week the last few weeks. You saw that in the the UK gilt market, or the UK bond market. Their bonds started rising and their pension funds blew out, and the Bank of England had to do emergency bond purchases. And that might be what you're seeing here, when you're seeing the Fed step in to try to prevent those yields from going too crazy up to, right, because we talked about the 5.22% level that's acting as a magnet as well as a yield cap. Personally, I think if the Fed, doesn't intervene, that these yields will rise to 5.22%. And, in that case, insurance companies and pension funds, to the extent they're leveraged, which a lot are, they're going to be in a lot of trouble and might need assistance. Those are the type of institutions that do get bailed out. So they may be, accessing the Fed's bank term funding program. So we might see that swell in the future. That's also something to keep an eye on. If there is strain in the system, you'll see this facility start to swell. And to the extent, it pumped after the Silicon Valley Bank collapse, and then it has swelled since, but not dramatically. If you see a new exponential surge and parabolic rise in this facility, that trouble is brewing in the system, and a lot of money is being printed to cover up the holes. Anyway, so the carryover effect that has on equity markets is the Fed is sort of creating an incentive to buy any bond that rises above the 5.22 1-year fixed swap rate, which doesn't apply to the 30-year, but it does apply to the 1-year. And so I think if you were to track banks' balance sheet balances, you would see their purchases of 1-year, government bonds or short duration bonds start to swell. And this only applies to American banks, doesn't apply to foreigners. So I think if you looked at their balance sheets, you'd see them sort of dumping treasuries. But the Fed has basically created an incentive for American banks to buy short duration bonds. And what that does is it basically, it's effectively uninverting the yield curve. We talked about that. Like you still have an inverted yield curve, but it's less significantly inverted, and it's creating an incentive for, the long end of the curve, like the 30-year yield, to rise up to the 5.22%, while there's an incentive for like the short end to stay capped at 5.22%. And assuming that the long end is, able to rise, hopefully slowly rather than abruptly, but assuming that it does rise to that level, then you could have a situation down the road where, the short end remains the same and the long end rises to meet it, and then voila, your yield curve is uninverted. I kind of think that's like what the Fed is trying to do here. They're trying to manage it along and make sure that like nobody blows up in the process of them doing this. But that's just my theory. But essentially what that does is it creates an incentive for banks to buy a lot of short-term bonds, which they can then pledge as collateral to get, other financing, which they can then put into risk markets. And because this new 5.22% is sort of like the yield floor, right? It creates an incentive. Other investments, other debt instruments have to yield more than that to create an incentive to for any capital to flow in. And that's one of the reasons why you're seeing, at least in my opinion, you're seeing equity markets rise, is that demand for higher yields, not just on treasuries, but also, returns on equity. And one thing banks can do after they purchase a lot of short-term bonds is they can pledge that as collateral to get financing that they can then, buy like a broad-based S&P 500 index. And they don't have to worry about those bonds, suffering severe losses because, again, they can just pledge those bonds to the Fed, and the Fed has promised to cover all their losses, essentially. So anyway, I know it was very long-winded, but it's a way to explain why the market has just been up only since March, and that program was unveiled. I mean, it's sort of, this is not a coincidence that this happened that way. And the conditions that have led to this are still in place, right? The BTFP program is still in place. The incentives are still there. They haven't changed. And CPI is still significantly lower than where it was earlier in the year, or earlier last year around this time, like 8.5. So I think that's another long way of saying the conditions that created this up-only market are still in place, and assuming that they remain in place, then I think you'll see the rally continue. I don't think that this will be, a local top in the way that a lot of people are looking at it, like, that it's going to top out here and create new lows. Again, assuming that the conditions that led to this rally remain in place, I'm expecting it to continue until those conditions change. And for me, just sort of walking down this scenario is, I still think, if you look on Twitter, you still see people like are pretty bearish. Like they, of course there are traders who are positioned, bullishly. There's always people positioned a certain way, but if the way you can tell is like when you look at sentiment, people are not in buy the dip mode, right? That's sort of what you see when you see like a bullish sentiment. People are in, like, every time there's a pullback, people are in the mode of like, okay, this is like the top, right, before a major collapse. That's because of the bearish sentiment. If sentiment was bullish, they would be saying buy the dip because this thing's going higher, and that's just not what you see. But I think that, it's a long way of saying we're climbing the wall of worry still, even after all these months. And really, price has been going up pretty dramatically, but it hasn't like really been parabolic. But I think that would change if you took out the all-time high. If you had, as we were talking about before, say you had this quarterly candle close above 480 on the S&P 500, in that hypothetical scenario, then you see the parabolic push up, and in price move very, very rapidly up to the 600 level, and then probably the 700 level in a very short period of time. And I think if that scenario were to play out, that that it would happen definitely before year end, and probably sooner than that. So I think, and then if that were to happen, like, you would see all sorts of repositioning, right? You would see that bearish sentiment flip into bullish sentiment, where now everything's buy the dip, and everybody's repositioning. Everybody's basically moving from one side of the boat to the other in the market, and that's sort of what would cause the market to rise very parabolically. Again, that's sort of my base case. I always have to add the caveat that doesn't necessarily have to happen, but I think just assuming conditions remain the same, that's sort of what I'm looking for. People may think that's a little bit crazy, but whatever. I mean, basically adopting a contrarian mindset is generally going to lead to favorable outcomes. Most people are wrong in the market, and really most people are wrong at the worst time in the market, right? Like, the people are most bearish at the absolute bottom and most bullish at the absolute top. And there is a period where the pendulum swings between one way and the other, where contrarians aren't really contrary at all, but because they're contrarians mainly at the extremes in the market. And I think that's the most important time to be a contrarian, is when the market is at extremes, to guard yourself against that. And it's most important like in euphoric parts of the market, because when people are in a fearful state of mind, they generally tend to be more disciplined in the way that they manage risk, and adhere to their risk management principles. But when people are like euphoric and basically consumed by a state of euphoria, that's like when they're least likely to manage risk, and that's actually like the most dangerous time in the market. So it's important to have a plan for what you're going to do if that type of euphoria plays out, because if you have a plan and you have it written down, then it's much easier to not like give in to that euphoria, because you have a plan written down and you got to look at it, right? And it's like it's a reminder that, okay, like, this is my plan and I should stick to it, and it'll help you sort of manage those emotions. So again, it's just sort of a recommendation that if you don't have a plan written down for what you're going to do under different scenarios, it's probably a good idea to write a plan down. It's really a great compass to navigate through the emotions of the market, is having a plan, for obvious reasons. Now, I'm sort of in the mindset that I think, I kind of think that the market the interest rate market has sort of topped out. You've got interest rates, basically the market is pricing in a Fed pause at that September FOMC meeting, and I think that's very possible. I think it's the most likely scenario. But what I think is also possible is, I think, if we had this parabolic run that I just discussed the possibility of, then I think you have the potential for the Fed to make a mistake and to raise interest rates just because they're not happy with, the fact that equity markets are rising, especially parabolically. Like, they'll try to fight the equity markets down. And I think if that happens, that will be a fatal mistake. A really, really fatal mistake. And it cause a lot of people to get caught up. The Fed has already over-tightened financial conditions. Credit risk has already surged to a level that is not becoming of like a healthy, functioning economy. And you're already seeing loan originations dry up. And we live in a debt-based market, so if you have loan originations drying up and companies aren't able to get financing, like, your economy's going to contract. That's just the way it is. And that's what's happening, but you're also seeing equity markets rise in spite of that. So, if you have a parabolic final melt up in the equity markets and the Fed is, has already over tightened, and then they raise interest rates again to spite the equity markets, like, that'll be a mistake. It'll probably lead to a major bust in the market. So, you could see a melt up and then a crash. It's sort of the way I'm looking at the stock market is sort of like it's 1999, in like the peak of the .com bubble. So I'm certainly not long-term bullish, just short-term bullish. And I think cautious is a good word, right? I think a lot of people will get caught up in that scenario if it does play out, and it's unfortunate because they don't have to get caught up in it. But in that scenario, the way I would play it is, if you guys have been following me for any time, you know that I think bonds are a terrible investment. Just bonds broadly are just really, really, really not going to pay you out. Let's see if we can have these technical issues again. Let's see. All right, so I got to go back to TLT. All right. So as you can see, the TLT is basically an ETF of the long end of the U.S. bond curve, and you can see it's like very declining, which makes sense because yields have been rising on the long end recently. So you see a decline in the underlying value of the bond whenever yields rise, because why would people pay a lot of money if you have a 20-year bond that yields 2% from 10 years ago? Who's going to buy that, right? They're going to buy the one that yields 4.8% today. And that's why you're seeing these low. But if interest rates were to top out and the Fed were to pivot into a interest cutting cycle, which will ultimately happen, it's inevitable that it will happen because the financial system is a Ponzi scheme and can't endure long rates forever. It's inevitable that they will cut rates, but it's not clear when that will happen or when some type of event that makes that immediately necessary will happen. But the way I'd be looking at it is like if you after each, say the equity market starts going parabolic and you get the S&P 500 trading at 550 and then like 600 a week later and 650 a week after that. I would be using that to sort of transition into the bonds, particularly like I don't necessarily know if I have a bias towards the short end or the long end of the curve actually, but I would be seeing that as sort of, and there may be future interest rate hikes beyond where we're at now, but I think we're sort of near the top. And I would look at bonds as a very good short-term trade, particularly after a new interest rate hike. Again, going back to the idea that I think if the Fed will raise interest rates beyond where they're at right now, I think there may be one or two interest rate hikes left of 25 basis points at the minimum. So, and then, say the Fed were to hike another 25 basis points in September, then you would see bond markets crater, and that would be a buying opportunity, to at least short term on the, assumption that maybe the bond market, maybe interest rates have topped out. And then if they were, if there was another 25 basis point hike in October or something like that, that would be another opportunity. The underlying theory being that, the market can't really afford many more, right? And once interest rates top out and the Fed does cut rates and yields fall, then a bond portfolio would do very well in the short term and better than an equity portfolio would do. If you backtest equity performances when the Fed cuts rates, it's actually pretty abysmal. And that's sort of contrary to the narrative that is going around on Twitter right now. They sort of think that, interest rate cuts are good for equities. They're really not. All you need to do is backtest that, see when the Fed has cut interest rates and what effect it's had on equity markets. It's really not good. But it would be extremely beneficial for bonds in the short term. So if you think, if you want to take a trade, the interest rates have topped out, you buy bonds. But, that doesn't change the fact that holding bonds to maturity is not a good play, right? Because while I think interest rates may have topped out like in the short term or are near the top in the short term, long term, I think interest rates will rise to new highs. Like I think, maybe it's topped out at 5.22% right now, yields are, but 10 years from now, I would expect yields to be much higher than 5.22%. I think yields will probably be in the double digits in the not too distant future. And that means that, you've got, say, the 10-year treasury trading at 11%, mortgage rates, if you want to get a mortgage, you might be looking at like 13%, 14%. And that just makes like long-term capital in the real estate markets and long-term capital in the bond market just look increasingly inefficient. And I think you'll see a lot of capital leave those markets, a lot of long-term capital, and move into markets where long-term capital makes more sense, right? And when you think about an asset like Bitcoin, you can hold Bitcoin for a long period of time, and the longer you hold Bitcoin, the more it makes sense, right? It just goes up in value every 4 years. The next halving is like 250 days away, or 37,000 blocks away. It's programmatic, it's going to happen, and it's going to have a beneficial effect on the price. So any capital you have that you don't need for the next year, really the best course of action for any money manager, whether you're big or small, is to invest that long-term capital in Bitcoin. That's just a no-brainer. And then you have, one thing that surprised me is you had a company like BlackRock come out, push their spot Bitcoin ETF, which, is sort of an endorsement of the asset itself. But what really blew my mind is BlackRock published a paper where they essentially said that their ideal portfolio allocation in any portfolio was 85% Bitcoin and then like 9% equities and the remaining in bonds. But it's just insane. 85%, it's just, it makes sense to me. I understand it, but it's such a rapid, like they went from like 0 to 85% real quick. And that has a lot of implications because, if all the money managers in the world were to just increase their allocation to Bitcoin to like 1 or 2%, you're talking trillions of dollars, and the price of Bitcoin would like 3x, 4x, 5x, just them going to 1% or 2%. There's no, like, that's the other dynamic with Bitcoin is like, if, they took BlackRock's word for it and created that 85% allocation, there's just not enough Bitcoin in the world for everybody to do that. And that's really where it gets interesting in the long term. So, on the short term in Bitcoin, yeah, I'm still bullish, but really, I mean, long term, that is where long-term capital needs to be, in my opinion. I still have this trade open. Let's see if I can put this on there. All right, well, the trade is not showing up here for whatever reason, but you can see here, this is just a paper trading account. I've got this Bitcoin 857 Bitcoin long position open from 17,656 from down here. So it's a long-term hold that I've been holding for a while. Basically because I don't really see a huge reason to pull off a lot of risk on it. If we go back here, you can see the history on this. You can see the P&L. So I've been taking some profit. There's losses as well. It's not all green. But all in all, the P&L is extremely profitable. But most of the position is still in equity, meaning that, there's still an open floating P&L of 10 million, which reflects my belief that this rally's not really over. I expect it to continue. I don't know how long it'll continue for, but, I'd want to hold the position open, at least until I see market structure breaking in some way. Let me just refresh this page. Pull this off. Let's see. There we go. And there we go. So, this is a very clearly defined trend on Bitcoin that has been playing out. And if you watch my previous videos, I've been talking about this, but basically you had new higher highs here, really. I mean, you could say that you had higher highs broken above here, but dramatically so here above the highs created by the FTX collapse. And you see price trade back into it, trade down below that break in market structure, and then react off it and not hang out down below there. And you can see the reactions getting swifter and swifter. So, Bitcoin came down into that break of market structure here and then spent a few days in there and reacted dramatically. Here, came back, tested the old highs, spent a day below it, reacted dramatically. And this one actually came down and didn't even touch the highs. It actually got front ran by a couple dollars. If you were to zoom in on this, got front ran and reacted very dramatically off that high. And what you're seeing is, you're seeing a more aggressive response off those levels as the trend continues. So the way I interpret this is that the trend is strengthening, right? It's not weakening. And on the flip side, I think you could, say that if Bitcoin were to go down and like go down below this level here and hang out down here, that would be, a sign of weakness. So I think we actually can do this live and pull up. I just put a stop loss order down there, and let's see, 28,473. So we'll put a sell stop. 28,473 for 150 Bitcoin. Again, I don't want to manage the entire position, just a portion, because I don't want to get stopped out on the entire position all at once, right? I mean, that's never a good idea. So here we go, 150 Bitcoin at 28,473. Yeah, so that stop would take out roughly a fifth of the position, and I would have to manage the rest. But again, one benefit of using a partial static stop loss is that it's much easier after that static stop has been hit, to then, manage the position dynamically in the way that you need to afterwards, because mentally you've already taken the loss. So you've already sort of flipped in that mentality that you need to manage it. The idea being that, the market might give you opportunities to manage it at more favorable levels and sell it at more favorable levels. Anyway, I hope you guys like this video. I will be making more content sooner. So stay tuned for that. If you guys haven't subscribed already, please make sure to subscribe, leave a like